Good day, everybody, and thank you very much for joining Capital Link this month. I'm Angelica Kemene from Optima Shipping Services, and this is our February monthly pulse. As always, we'll keep it focused in oil tankers and dry bulk only, and I will try to present in a way that helps actually decision making rather than do headline chasing. Um, so For February reminded us of something shipping people know instinctively. Markets don't move because the world becomes certain. They move because uncertainty actually changes behavior. So on tankers, the signal was unmistakable. VLCC spot earnings reached about 146K per day last week, and that was the highest level we've seen since 2020, although at the time of speaking, numbers are higher. And what I find more telling than the peak itself is the persistence. So crude tanker earnings stayed above 100K per day for 3 consecutive weeks. Dry bulk, meanwhile, ended January at roughly 16K per day on average, and that's the strongest end January level since 2022. And in the background, Brent moved up to around $72 per barrel. Um, and that's up 16% since early January. So, not because demand actually suddenly exploded, but just because the market has been pricing risk again. So the theme for today, for our presentation is effective supply. So what is available, compliant, and deployable, and not actually what exists on paper. If we step back from the noise for tankers, the tanker story is not simply rates went up. It's that the system tightened fast, and it actually tightened in a way that's consistent with a market that has less spare flexibility than it assumes. So VLCCs printed that 146K per day last week, peak in late February. Um, but the broader crude complex has been strong for weeks. In clean, the market has been more volatile. MR earnings jumped into the high 30 Ks, then corrected back into the mid 20s. That pattern is important. It's what you see when a market is tight. Disruption creates sharp repricing, and then it normalizes, but it doesn't unwind into weakness. And one additional point from the deck, overall tanker earnings reached around 61.7 thousand dollars per day in late January, and that's the highest in nearly 3 years. It tells you actually that this is not a one-day story. This slide is actually the why, and it's a good moment to be very clear. First, geopolitics. The US and Iran tension has triggered a classic charterer behavior, paying for control, reducing uncertainty, securing ships earlier than usual. And when risks rises, owners don't just price risk, they also manage optionality more tightly, and that tightens availability. Second, we have sanctions, and we now track around 935 sanctioned oil tankers, and that's roughly 111 million deadweight, or about 16% of the global fleet capacity. Um, this is not a moral statement. It's a market structure statement. When that much tonnage actually operates in a separate universe, let's call it, the mainstream compliant fleet becomes tighter than the headline fleet size suggests. So the industry effectively starts operating as two parallel markets, as we have seen for so long. So third, we have Atlantic barrels that have mattered. Brazil exported a record 2.5 million barrels per day in January, and that was up 13% year on year. And shipments to China are up around 90%. That supports the long haul utilization, and it's actually one reason why the crude complex can remain structurally firm, even when the macro backdrop is not spectacular. Finally, the capital signal. Tanker asset prices are up since the start of the year, and in particular, older VLCC values have risen sharply. When secondhand prices move with freight, the market is essentially telling you this isn't just a spike. We think that the tightness has a shelf life. So the market is actually pricing restricted availability. Moving on now and turning to the dry bulk, the tone is very different, but it's not weak. We ended January very strongly with up about 10% week on week to roughly 15.2K dollars per day. And even with the New Year slowdown, we're still around 16K per day. Capesize has been choppy, which is not unusual in cyclone season, uh, coupled also with the lunar year. And we moved from the high 20s down to the low 20s and then recovered into actually the mid 20s. So the point is not the exact print. The point is that the market remains sensitive to timing, weather, and positioning. Panamax has been steadier and helped by predominantly actually helped by grain flow visibility. So our stance stays consistent. In bulk, this is a selective market. And you want exposure where cargo programs are visible and volatility is actually manageable. Fundamentally, the picture is quietly supportive with a clear split inside the cargo mix. Um, our trade data show that around 5% year on year increase was for January 2026, and after a firm second half of last year. And inside that, iron ore is up while coal is a headwind, and grain is softer. The miners are also relevant here. Vale delivered 336 million tons for the financial year 2025, and that was the highest since Brumadinho and Rio posted a record 90 million tons in Q4. Guineas seem fair. Reaching around 1 million tons is still early, but actually directionally it matters. So the point is simple. Um, and I would say that the bulk message is iron ore is doing at the moment the heavy lifting. Coal is the drag, and the near term price action will still be shaped by logistics and weather and disruptions as much as it is by macro. Second-hand tanker values remain firm. The 10-year VLCC values were up more than 20% year to date, and the 5-year benchmark also was higher since mid-December. That is meaningful, actually, because it confirms that capital is not treating this as a one-off event. At the same time, new building activity is clearly building. We had more than 150 vessels ordered year to date. Prices are still elevated, and notable contracting has been seen across crude, clean, and even cape sizes. So our conclusion is not buy everything. Is the market is confident, but the supply response is forming, which means 2026 will reward discipline and segment choice. Two practical risks to keep in view. First, the trade policy uncertainty. Changes in tariffs don't just affect volumes, they affect sourcing, and sourcing changes routing. Shipping monetizes distance and friction, so policy can matter even when demand is stable. Second, proposals under the U.S. Maritime Action Plan, including potential fees linked to foreign-built vessels carrying imports. Um, so whether every element becomes law in less important is actually less important than the direction. And policymakers are exploring tools that could reshape deployment economics. And routing disruption actually remains relevant. Red Sea transit are still materially below prior norms, with a large number of container ships continuing via the Cape. And for tankers, Middle East risk remains a dominant catalyst. So 2026 is not just a supply demand conversation, it is also a rules and route conversation. So into March, for tankers, the swing factor remains geopolitical risk. De-escalation would actually cool the market. Escalation keeps it tight. OPEC Plus decisions are also central for ton miles, and sanctions enforcement continues to fragment supply. For the dry bulk, we typically expect activity to normalize post-lunar New Year, with iron ore remaining supportive, coal still a drag, and cyclone season keeping Capesize volatile. Um, one closing thought now, it's that when markets fragment, averages become less useful. So the winners are usually the ones who focus on where the freight is generated, which ships can trade it, and how policy reshapes effective supply. That's it for me, this man. Thank you so much for watching, and until next time, thank you very much.